My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Boaz Weinstein, who a lot of people consider one of the legends in the industry. I had a quick back and forth, Boaz, with Louis Vincent Gobb, who I had on a space, and he said he met you a number of times. He unfortunately can't make it, but was very complimentary of your success and your skills. So this should be a great conversation. But for those who are not familiar with your background and your story, Boaz, introduce yourself. Who are you? As you get involved in markets, and what are you doing currently?
Sure. I assume everyone can hear me okay. This is my first time on Twitter Spaces, so hopefully my mom won't call in and all of a sudden everything will conk out. But so I'm really glad to be able to speak to you all and for Michael to have invited me. Let's see. So I've been investing since I was a kid. I got interested in the stock market when I was a teenager, almost through osmosis. I had a bedroom that was a split living room bedroom where my parents put up a makeshift wall, and I would listen to Wall Street Week from a young age. I think it was on at 8:30, and I would go to sleep hearing Louis Rukeyser's soothing dulcet tones. And so I wanted to work on Wall Street, and I got super lucky. At first, I was lucky that I was not exactly looking for a job in high school, but sort of looking, and there was a job opening at Merrill Lynch with one of the best mother-daughter broker teams in the history of Merrill. Actually, the mother on her own was a top 10 broker out of whatever it was at the time, 14,000. And I got to come in and do clerical stuff. So I was able to leverage that and my interest in Wall Street into learning a little bit and getting Goldman Sachs to actually agree to have a perfunctory meeting with their recruiting person for summer jobs. And, normally they recruit junior year or maybe sophomore year. I was freshman. And it was perfunctory, but I got super lucky on my way out where they said, come back in 2 years, maybe. We're in the men's bathroom at the Saints. I ran into someone that I had met at a chess club that had brought some of the world's greatest players, not just world champion at the time, Kasparov, but even Mikhail Tal, just like this unbelievable thing that was at Milbank Tweed, the law firm, and partner there, Bob Rice, really helped change chess about 20 years ago, or certainly tried to. And there was a Goldman partner there who played some games with me. He actually has the incredible collection in Connecticut of artifacts from the game going back to the 15th century. So he set in motion basically 3 rounds of 20 to 25 interviews of math puzzles and personality tests and what have you. And the short story is I got the job, and were it not for that one little moment. And I think all of you think about it, things that went really well in your career or really not well. It often can come down to small moments that didn't need to be. And you can try to create extra optionality to make more of those moments, more lottery tickets. But that moment, by me trying, and then the luck, and maybe say, well, I should have approached that guy from the start. But anyway, we found each other. The rest is history. I got to work as an 18-year-old, 19-year-old on a desk of 6 people. The 5 others were literally, at the time, it was just a guy called David Tepper, who now is, the David Tepper, and Jonathan Kolach, and, Jim Zelter, Bill Troy, and David DeLucia, the partner who made everything possible for me. And I was 6, and I got to learn an incredible amount. And I knew then that credit at the time was very focused on the accounting, the deep fundamental analysis, and that would not be my highest and best use. I was more quantity. I went to a math and science high school and was looking for something more quantitative that was still micro. So in the fixed income worlds where I got this lucky job, I was planted, and I was waiting for credit derivatives to be born. And 1998, is when I was among the first, if not the first, credit derivative market maker / proprietary trader, not someone who was just filling orders for the bank. And that's been my domain expertise. It still is. A lot of the things we do here are offshoot. It's not just credit derivatives. It's credit derivatives and their relationship to bonds, to loans, the shape of the curves, where we can borrow from how to think about curve shape from macro markets and credit against equity. And then I hope we get to talk about this a lot, Michael, but for the last decade, closed-end funds have fascinated me. Much greater investors have come before me, like Warren Buffett and Ed Thorpe, which hopefully we'll get to some stories about them and me and closed-end funds. But that is what I received a lot of incomings for today's Twitter Spaces, and I'm so glad to be doing this to go into some detail about how we look at it and what's actually happening with some of the fights.
I think it's interesting how somebody grows up impacts what ends up being their ultimate direction for career choice, in the sense of, I heard you say small moments, optionality, lotto tickets. And if you just try, right? And that's a good transition to the closed-end fund world, because if you're trying to take advantage of these discounts, you have to try to affect change. So maybe for the audience, explain what a closed-end fund is. Let's go very basic first, educational for those not familiar, because it's not as well talked about as it used to be. And what makes that space particularly interesting for you with Saba?
Yeah. So a closed-end fund is a registered investment company. A few hundred of them trade on the New York Stock Exchange. So we're talking about public closed-end funds. There's the London Stock Exchange, Australia, Canada. Between those four regions alone, we have about 750 plus funds. They do different things. They invest in US equities, but with a wrapper, with a vehicle listing in Australia, or municipal bonds, or taxable bonds, or loans, or opportunistic in fixed income, or EM, and on and on. If there's demand for it, BlackRock will sell it. There are ones that are focused just on with an ESG label, ones that are just technology stocks. So it really is, in a sense, a excellent way for investors to get one-stop shopping, exposure to a great manager in some cases, and then because of the closed-ended nature, which is really where it's useful to very simply explain it. It's just like a regular stock where if you want to sell it, you have to find someone to buy it. Now, the ETFs or mutual funds that everyone here knows well are different, because you want to get out of your mutual funds. Of course, you're calling the company. You're not trying to find someone to buy it, and you're getting NAV all the time. Exactly NAV. You're getting cash. They're cashing you out at NAV. In an ETF, though, there could be little slippages where it's slightly above or below, and maybe people like Jane Street or Goldman Sachs are keeping it in line. An ETF is tethered to NAV, and if it's not, you may create or redeem shares. So the share count changes, unlike a closed-end fund or a stock that didn't do a secondary. And so again, you can always get out at NAV. So there's this idea of you always can get what it's worth. You may not like how the manager did, but you can always get what it's worth. With closed ends, sometimes you can't get what it's worth. Sometimes you can get more than what it's worth. So we may talk about closed-end funds trading at a premium. And so with all of that, I think what's super neat about it is the discount or premium, because unlike normal investments in the market where, you think Nvidia is going to 500 and someone else thinks it's going to 300. And there are sharp disagreements over what the value ought to be today. At least with closed-end funds, you have simplified the type of analysis you're doing when it comes to trying to find value in closed-end funds. You might say, I think this manager is a good manager. I think this other manager is better, but their fees are too high. You can make those distinctions. But if there are funds, as there are today, about a quarter of the funds that are trading at a discount to their objective NAV, like we can use the closing price on the New York Stock Exchange, or, however the way the bonds are marked off of the last trade, and exactly the same way for mutual funds and ETFs. We know what NAV is, and there's a discount that is more significant than what a reasonable investor would expect to earn from taking all sorts of risks. So you buy a closed-end fund at, let's say, 84 cents on the dollar. That distance, 84 to 100, if it became an open-ended fund, it would go straight to 100, wouldn't stop there, wouldn't stop at anywhere other than 100 or 99. And that gain from 84 to 100, I think everyone can do the math. That's not 16%. That's almost 20%. It's 19.x%. And to make 19% where it, you don't have to be right about the next quarter's earnings. The portfolio will fluctuate up and down. And if you're long only, you will be exposed to that, but they're often super diversified. And if you are using open-ended funds because you want to hedge it out, you want to do an arbitrage, or you're hedging it name by name, you become only exposed to, is that discount going to grow or shrink? And when I think about the path to NAV, that kind of gain, a 19% gain, if it took a year, if it took 8 months, if it takes a year and a half, for the risks one is taking, is amazing to me. It's amazing to me because it's an arbitrage, the only one I know, where I can actually control the outcome, because I and the other, let's use a technical term, pissed off shareholders who are like, why is this thing at a 16 discount and it owns California municipal bonds? It's not because it owns weird private equity. It owns California munis. It's run by a venerable manager. Why is it at a 16 discount? There is a clear and easy path to making investors a 19% gain solely through the right of shareholders to elect a board that cares about shareholders and open-end the fund. So I'll pause there and see if you want to redirect me into something.
Yeah, no, that's great. No, that was very interesting. So from my perspective, there's always been two interesting aspects of closed-end funds. So one is the one you just mentioned, that there's these discounts, you can arbitrage or try to arbitrage them away and not take on necessarily beta risk of, or whatever risk the asset class has that you're trying to close the gap on. The other part of this on closed-end funds is I've seen studies that would suggest that if, for example, there's a number of, closed-end equity funds that are blowing out in terms of their discount, meaning getting some really severe discounts, it almost gets seen as it's almost like a contrarian signal on the asset class, because you end up having a discount being so large because people are selling, right, against the NAV, which causes a dislocation, which tells you that you're probably at an inflection point just from a investor sentiment perspective. That to me is always, I don't know if that's has anything to do with the way you look at closed-end funds, but is there any message or signaling when it comes to how wide that spread tends to be across that swath of closed-end funds?
Yeah. We didn't rehearse any questions in advance. That is a phenomenal question. I'm not trying to pander to you, because there are two really subtle takeaways when you wonder, why are some funds at a big discount? Why are some funds not at a discount or even at a premium? It's obviously very cavalier to say, more buyers and sellers. And there's a thing about them, which is that, this was said to me by a man that I think is, he's a great man, great guy, great civic member of the community, the president of BlackRock, Rob Capito. When I went to visit him the first time, the only time actually, we've talked about closed-end funds, we've met other times. He said, you got to understand, these products are sold, not bought. So I just want to explain that. And then I also want to get to these two things about what makes a big discount and what makes a premium. So what does that mean? A lot of you have heard that expression, sold, not bought. These products are sold, not bought. And he said, look, people call their broker and they say, get me Amazon stock. I need it. Get me NVIDIA. No one ever really calls and says, get me the latest closed-end fund. No one. Why would you do that? So the way these things are consummated is they are sold, not bought. The broker, the RIA says, you wanted California munis or you wanted US equities. Here's a great manager. They are launching this vehicle. Yeah, the fees are okay. Maybe they're a little high, but I think it's worth it. And they're sold. So there isn't natural demand at time zero. There's acceptance. I mean, of course, I'm speaking a little bit in generalities, but it's basically, there's never demand at NAV, because they're often going to go to a discount. And the only people who want them at NAV want them because of someone else telling them you should buy this and they're often the least sophisticated investors. Not to offend anyone here that has bought a closed-end fund at IPO. They're often the least sophisticated. They used to have with them effectively 5% loads, where you buy it at NAV, but 5% of the cash would go to pay the commission to all those deserving salespeople that made it possible. And so you were in at a 5% premium, even if the price was, at IPO. And so because there's no natural demand basically at NAV ever for most funds, again, generalities, when finally the IPO now, whoever, BlackRock's on to the next fund, they can't raise any more money for that fund. It's locked in. They can't create new shares like they can for an ETF. And so someday there'll be natural sellers. And that day, that for me was the first day institutionally I got involved in closed-end funds. I had owned a couple as a retail investor, learned about them in Barron's, subscriber, who often would talk about opportunities for retail. It was really a retail product. But I learned about it because in Taper Tantrum, June 2013, that's when they dropped to a big discount, because there was a tantrum, there was selling pressure, and to my earlier point, no natural demand. They went from no discount or premiums to kind of straight line to -10, -11, -12. Now, of course, there have always been funds at that level, but I mean, and bigger, but I mean a big swath of the market dropped 10% because there was supply and there was no demand. And so you can have that. That can simply be a reason why they fall, because they were inevitably going to fall. But once they get to a big discount, then it starts to attract really smart retail. It starts to attract a few institutions, and at some point, even an activist like ourselves. But so now let me get to, if it's okay, Michael, the two telltale features about why a closed-end fund is going to trade at a big discount. Let's do that. Okay, good?
Yeah, I understand. And there's a lot of good direction you want to go with it.
All right. Up. So what are the two things that are most likely to cause the fund to be at a big discount? Now, entrenchment. First word is entrenchment. A fund where the investor is powerless. Now, I'm going to pick actually what I consider to be a positive, an example where I don't have criticism. I don't have, bad things to say, but there's nothing to stop the fund from staying at that discount for a year or for a decade. There are ones where the entrenchment, I do have a lot to say because they've changed the rules on you, or they've, done things that go against good governance. But to give an example, because I get asked just about every 3 or 4 days, what do you think of PSH? What do you think of Bill Ackman's fund? I'll tell you what I think of it. I think he was very clear that there would be no activism in his fund. He gave terms that made it enticing for people to switch over from the hedge fund, fee terms and otherwise. And you just would not be able to tell the board through voting to change the rules, because you never could get to 51% of the vote because he had special voting rights. And that was known, that was right there in bold for everyone to see. And so if we look at things that are at the biggest discount, almost all of them, the reason are twofold. And one of them is entrenchment, meaning no matter how much we buy, management is going to do something so that they basically say, we don't care. We don't care that the board, it's not up to management. The board is supposed to work for shareholders, but we don't care. We don't care about your vote. And I'm going to give you an example with Franklin Templeton Fund, EMO in just a bit. But the reason I'm not negative on that reality that his fund sits at a 37 discount is that I think he's done a whole lot to erase that discount, or at least seemingly so. Like if you said, okay, but did you know that he's bought back a quarter of the shares? Not 2% of the shares, a quarter of the shares. Actually, I think it's even slightly more if you add up other senior people at the firm. Like, at some point, this selling imbalance, so why are things at a discount? More sellers than buyers. At some point, that selling imbalance can get cleared up. And someone could say, wow, I get to own actually a really interesting, impressive manager. It's had ups and downs, but over the long haul has done really well. And I have it at this giant discount, and it already had discounted fees. So, but it is, to be clear, it is there because there's nothing anyone can do about it, and there's more sellers than buyers. On the less positive side, there's stuff like if management says, I know that the board, or if the board says, we are here working for shareholders, but it turns out that actually we're going to violate the 1940 Act, we're not going to let large shareholders vote all their shares. If you have more than 10%, we're going to employ a share control provision that a certain state law allows us to, in clear violation of the federal law passed in 1940 that says every share gets to vote. And, we don't know which law is right. Is it the state law or the federal law? Well, this year, in a case in the Southern District of New York, Nuveen lost in summary judgment against Saba Capital on this exact issue. And so any funds where their main business is set up in New York would look at that and say, okay, I guess the judge has been very clear. Summary judgment, Saba wins, Nuveen loses. Probably we should let them vote their 13% of the shares. But some managers have chosen to basically pay a lot of legal bills to delay. And we've had a lot of success in the courts, but entrenchment can lead to discounts. And so I mentioned that I was going to say Franklin. You could look at a fund, EMO, Edward Mary Orange, where this year we got something like 64% of the vote. We would have had 70, but they tried they decided to borrow money through preferred stock to issue preferred stock for their leverage instead of using bank lines. And that preferred stock carries a vote, and they issued it to someone that would vote for them perhaps. And so instead of us getting 70, we only got 64. We got 64, but they had set up rules that say that if we don't get over 50% of all shares, not just the ones that vote. So imagine in a US presidential election, literally, 100 million people sit at home and don't vote. Those votes go to the incumbent. So that those things these are not things that are done in corporate America. They're only done on the public closed-end funds, and they're only done because the manager is basically so resistant in some cases because they want to keep the funds in closed-end form. They don't want it to be a mutual fund or an ETF because the stock market will value them at a lower multiple if the money is daily liquidity instead of, semi-permanent. And so, all right. So I talked about entrenchment. If activism is not going to work, or it's going to be a lot harder, and there's remedies for even EMO, won't give it all away on this. But so if that's not going to work, it deserves to be at a big discount because, by the way, these funds are often also disappointing. In EMO's case, they own MLPs and energy equities, and they're using leverage. And I think a fund that has underlying exposure of energy equities is much more risky than California munis. And I think you all would agree. The problem is with the leverage, And with what happened to oil in 2020, they had to sell at the bottom. They hit a level where they had to basically liquidate the leverage at the bottom. This happened in '08 as well. And so these funds, when those things happen, can never again beat their benchmarks because they had a levered loss into a giant sell-off, and investors should be and are pissed off, and that's why the discount's there. And then they, to add insult to injury, employ tactics. So I mentioned entrenchment. I'll be more succinct so you can get a lot more questions at me. The second thing, which I think is really interesting. So you wanted something where you could get a takeaway for, is there a broader signal to the market? Here it is, Michael. If you map closed-end funds that have 100% public owned holdings, so, IBM, AT&T stock, whatever bonds, and map and do it all the way down to closed-end funds that have 100% private holdings. I think all of you know where I'm going with this. There are some funds, largely in the UK, that have private equity. There's also funds with private debt, but private equity. And there are some funds, the more private you have, the bigger the discount is. The more uncertain what it's worth is, the more inability to hedge it if you wanted to hedge it because it's private is, they're at discount. So the largest closed-end fund in the world, the Scottish Mortgage Trust, SMT, on the London Stock Exchange, SMT, 9 billion plus pounds, trades at a 22% discount, and it has 20 to 22% privates. And those privates are not even ones that I think are necessarily hard to value. Like SpaceX is the biggest holding. That one's super easy to value. But I think the takeaway, what the market is saying is, like you heard the noise about when people said, did Tiger Global mark their private book down enough last year? Is the market is saying, we don't believe the valuation of privates. And so we're going to penalize those funds. And so that's, I think, really interesting. At the moment, there's even a fund we bought. There are funds we bought recently, let's say, that are at a discount to NAV between 30 and over 50% because of the private problem.
Yeah, no, that actually is very interesting. By the way, if everybody's here, please make sure you follow Boaz Weinstein on Twitter. And again, I know a lot of people want to come up and ask some questions, so I'll try to circle around this. I want to relate that to the name of the Twitter space around credit risk and the market endgame. I know that sounds dramatic, but yeah, I'm going to make the assumption that discount variability is also a function of just market dynamics and volatility in general, because it's ultimately all about uncertainty. Is there a link between discounts in the closed-end world and credit spreads widening? Is there any kind of signaling that comes from that standpoint? Because that's where I saw a number of people were asking questions when I announced the space about your thoughts on credit spreads being tight or not. And I have to assume there's some kind of link.
Yeah, there often is a link. You find there's a pro-cyclical reality to when closed-end funds are at big discounts, people wanted to sell them. When do people want to sell them? When there's fear in the market. This is actually a really weird year because we're buying closed-end funds on average at a discount that is more or less where they were in March 2020 when they plummeted because of course, COVID. Not the worst day of 2020, but let's not comp ourselves to one day in March. The discount is the best discount we've ever been able to buy at. That's why we own over 3 billion. We 2 years ago only owned 650 million, and markets are up and credit spreads are tight. And so I think that relationship, Michael, is very loose, but it's also not a great time to talk about it being anything but loose when you have a world where the market's rallying, credit spreads are tightening despite a rising default rate, tightening lending standards, a regional bank crisis that maybe isn't a crisis anymore, but it certainly is not going to make regional banks interested in sticking their neck out even more in private lending. And, this recession that never seems to be in front of our nose, it's in the distance, it's always 6 months out. People are kind of tired of waiting and they're looking at good news like today's CPI and saying, I can't not be long. Like we have this culture of I can't not be long for more than 6 months. I tried it, I got worried, and now I can't beat them, join them. Look at, it's all about AI. And so, they're foregoing the 5.25 on its way, 5.5, maybe higher risk-free rate to say, I need on top of that to own high yield credit. And so I've been getting from some of our investors, some pieces. I put them out on Twitter I really do that world of being able to communicate our thoughts and ideas. And I've gotten some nice feedback about it. I have 5% the following you do, Michael, so I'm not very good at figuring out how to do that. But when I see so many pointers that say, despite all the cheer with low credit spreads, low vol, and rising default rate, and that backdrop, that there ought to be more risk embedded. But the closed-end fund risk the discounts are big everywhere. They're big in MLPs. They're big in munis. They're big in equities. So I don't see a signal from closed ends. I do see increased demand for CDS from banks, which is no surprise after Silicon Valley Bank. Like, for example, I mentioned at the top that we're very involved in CDS. I've been in the CDS market for 25 years. I can't remember a time, now maybe there was, but I can't remember a time where there was real demand for someone to buy protection on Apple Computer. And it happened when I was in London just a couple of months ago, a month or two after Silicon Valley Bank. CDS and Apple Computer, obviously it's worthless. Obviously it is ultimately worthless. What is the point? And so I want to use Apple as the way to make this point. I could have picked IBM. I could pick a lot of other amazing companies, Abbott Labs. The point is the banks make the loans. The loans are made for relationship reasons. The bank's not going to get rich lending money to Apple Computer. They might get some M&A assignment. They might get some, all the different things to service one of the greatest companies in history. But what they do not get to do is tell their regulator, this should be 0% risk weighted. Obviously, it's zero risk, so don't make us hold any capital. They have to hold an amount of capital. There's the regulatory amount. There's, for their risk models, the risk amount. And if they buy CDS, and this is not just US companies, this is US banks, this is European banks as well, whether it's different kinds of tests, Basel, the Fed, that if they buy the CDS, the capital is retrieved. So it's freed. And so for all of these stress tests, capital ratios, buying CDS, if Jamie Dimon said, I'm bracing for a hurricane, and he did say that, what did it actually mean? Did he put on a raincoat and go hide in the basement or get a better umbrella? No. It meant that JP Morgan is actively de-risking. Well, where is the biggest risk in a bank? It is more in the credit markets than in the equity markets. And I don't want to speak for mortgages and interest rates, but in credit, what it meant, and it's much, much more in loans, which banks make, than their bond portfolio, which shrunk dramatically after London Whale or after, 2008. So if they have these loans, and these loans, which they do, and the loans are attracting capital, and Jamie Dimon says, I want to batten down the hatches, the cheapest way to hedge $1 billion, $100 billion of risk is to buy protection on the best companies in the world because the costs the least. And so we are seeing a lot of demand on names that I had not seen before, or names we have seen before, but in much bigger sizes. Someone came to me last week with a demand to buy, or desire to buy 50 million of Google 2-year CDS. And so I look at that and I feel like, wow, that's my raw material, stuff that I feel is not arrogant to say are not going to default, and they're not even going to get downgraded to below investment grade in the next 5 years. It's be preposterous for that to happen to Apple or Google. I take that as my fuel and I go and spend it on CDS, on put options, on the VIX, on, mostly CDS, on things that actually may blow out. Now, maybe not default, but maybe blow out. And so that is, I've kind of answered your question while also describing how do I approach tail protection. It's fund it with things that are safe, whether it was SPACs, which are really T-bills in a box, cash in a box. Before they de-SPAC, you get your money back. So that's safe. IBM is safe, and I go in short unsafe. And that's been kind of my approach. But anyway, to answer your question, come back around in one sentence, we are seeing a lot of demand for CDS these last few months. And I don't know if it's a signal of anything other than banks want to be prepared. They want more. They want to do better on stress tests. They want to pay dividends. They want to buy back stock, but they certainly have seen how quickly a bank can fail, and freeing up capital to show that you would perform better, you have better ratios, has been something that has been the biggest technical trend in the CDS market, to the point where the credit spread of a company to me today versus that time I was a summer intern or at Goldman, or, the beginnings of the credit-driven market, the determination of a credit spread today, especially in the CDS market, has almost everything to do with technicals. Is there a giant buyer of protection? And that buyer ain't Ken Griffin. That's some guy who just girl that needs to hedge, man or woman needs to hedge their exposure to Apple. They don't have any knowledge or any untoward feelings towards the company. They're just almost like a utility within the bank, performing a valuable service. That they are a bigger determiner of where IG credit spread should be than fundamentals by far. And there's all sorts of technicals. There's the macro CTA community that embraced the credit derivative indices, but the players that are driving credit spreads today could not be more different than 15, 20 years ago.
That point you mentioned about discounts, most of them are discounts, like going back to the 2020 COVID period. I wonder if some of that is just driven by FOMO and mind share around tech and AI. I have to assume that when you're in an environment, a macro environment where the market risk assets in general are being driven by just a select number of securities, that maybe results in those discounts widening because there's less money trying to take advantage of it because play the hot dot, play the momentum somewhere else.
Yeah. Well, look, they did go there. So there's a fund called Big Z, BIGZ, BlackRock Innovation and Growth Trust. And someone just tweeted about it a little while ago. And they had bad timing, like who knows the future. They IPO'd it, I think, March 26, 2021. That was not a great time to try to mimic Cathie Wood, but there was demand. And, these products there actually was demand. So maybe this one was an exception to the Capito rule of these products are sold, not bought. And so they issued $5 billion of Big Z. They IPO'd $5 billion. You can go look right now. I don't have it up in front of me, but it's somewhere like a 1.7 billion market cap, even though its NAV, and I trust that BlackRock is calculating the NAV on the privates properly. That one does have a lot of privates, is 2 billion. So there's a 300 million gap. But so, when ESG was hot, BlackRock issued an ESG trust. And so you do see like the fad of the day. And you started this question with AI, so it made me think of Big Z. But the thing is, it's like, we're going to win, we're going to lose, we're going to have bad timing, we're going to have good timing in this business. If you drop, it's trading now at a mid-teens discount. It was above a 20% discount before we started buying it. But if you're going to lose more than 50% of your investors' money, and then on top of it, you have this discount, it is just, when I read how they defend themselves, they actually say, well, we beat our benchmark. Like there's no, I'm sorry guys, we actually screwed this one up. Like they literally turned 5 billion into $1.7 billion in 2 years and 3 months. Yes, they were going to lose money being an innovation growth. But on top of it, this yawning discount, which would be bigger if we lose, is my belief, because it was bigger before we got involved. And often when we lose the first round or whatever the number of rounds are in that fight, people say, oh, I thought Boaz was going to win, or I thought BlackRock was going to be sensible, given they already have $9 trillion, that they were actually going to show the entire investment world that actually they're performing good governance. And I'll get to some good governance examples, hopefully. And actually our employees own this thing. So we're going to be showing employees that we care about them. And by the way, the board is supposed to care about them actually as their main job. And we could press a button and turn this into something that would not be at a discount. Actually, would require a slightly different plan because of the privates. But I could have been talking about ECAP, the ESG fund. BlackRock has 10 different ESG mutual funds. One of those is going to be, if not all, are going to be super suitable to merge with ECAP, and every single investor will benefit. It will go to NAV. You can get out of it if you want to at NAV. You can stay in knowing it's always going to be available to enter or exit at NAV. And every single investor is going to make that discount back. You know how I know that? Because it's never not been that way. You know how else I know that? Because BlackRock said it. You could look up a couple of closed-end funds that we were activist on. They tried a different trick to not us be able to elect a board. Spare you that story, although it's a good one. And in 2020, they came back and said, actually, nothing. They didn't mention Saba's name. They said, here are 4 reasons why we are taking these 2 New York Community funds and merging them with BlackRock New York Community open-ended funds. We're doing it for 4 reasons. Number 1, the discount will go away. This is BlackRock speaking, not Saba. Number 2, the liquidity will be better because it will be part of a bigger thing, a bigger fund, and there'll be more liquidity. Number 3, the expense ratio will go down because it will be bigger. And number 4, there's no tax implication. So they did that, and they wrote why they did it. And no matter how many times I tweet at BlackRock, at Larry Fink to say, what are you guys doing? You have $9 trillion. These funds are owned by your employees. You can press a button. You can show leadership. And on top of it, you have told everyone what ESG is supposed to mean. You not only told everyone, you've written it. You have written it down, and you are violating your 10 commandments in like 4 different ways, maybe 11 ways. So how is someone, when me shouting into the cave finally reaches management there, how are you not going to, for what? For a few $100 million of AUM coming out of that fund to the gain of all your shareholders? How are you not going to do that? So anyway, so now I digress because you asked about like products being issued. But yes, the products that have been issued lately, the last couple of years, were mainly equity funds. At the same time, it is hard with the discount as big as it is now for them to actually rationally think that they should bring a new deal when so many existing deals are at double-digit discounts. So the IPO market for closed-end funds has slowed down a lot versus 2 years ago.
For the record, I love being in a cave hearing somebody yelling at BlackRock. So I'm glad to see that. Anyway, let's go to some of the audience.
So our record is, it's high. It's high because we're not predicting the weather. We're not predicting, who can win at a game. It's the knowledge that there are a lot of disgruntled shareholders. They cannot organize. We are not doing it for them, but I happen to love that they get to come along for the ride. And so if you buy more shares, you have more votes. I mean, you ought to. I mentioned that some managers like BlackRock, we actually just had to sue 5 managers to get a judge to tell them what they just told Nuveen, which is the 40 Act very clearly says, and I'm sure Chair Gensler, who has written about mutual fund fee abuses and things like that, I haven't had the pleasure of talking with him yet, though I had spoken to his predecessor, Clayton, that you got to think about the little guy, it's your entire business. So first, you had asked about, so the first part of your question, you asked about leverage, right? So leverage is, I'm glad you brought it up because the leverage to many investors could be considered an attribute. And I mentioned on MLPs how it's also a danger. And what is not very nice is that the fees are higher when there's leverage than when there's not. Now I think about it from my perspective. I'm a hedge fund manager. I get X in 20, let's call X. I'll tell you what X is. It's 1.75% for my fund. Okay. It's 1.75%. If I love things or I don't love things, if I bring cash levels up or take cash levels down, it's the same. In a closed-end fund, they are charging fees on what's called managed assets. So it's literally like, hey guys, investors kind of want leverage because that's what they signed up for. So let's assume they want it at all times, because if we give them max leverage at all times, we get max fees. There's no incentive fees in these US funds. So that's the way we get fees. And so you end up in these moral hazard problems where the manager is running at full leverage into a brick wall. Let me give you an example where you say, okay, let's say you say back, well, who knew the brick wall was there? Did you know it? I didn't know it. I don't see those things coming either. So let me give you an even worse example. Let's take BlackRock, our friend, and California muni funds. Okay, so now we have this world where, let's talk about leverage in a world with ZIRP and leverage where the Fed funds rate is 5.25, ticking higher. Tim Rose says they're going to go for it again in then just 2 weeks. So when BlackRock employs leverage to buy California munis, it is paying that Fed funds rate. It's paying a spread on top. It's in the 6s. That's my belief. Pretty sure it is. It's in the 6s. They're spending your money to borrow. They're paying in the 6s. What are they getting? What about when you start to realize, well, because of this inverted curve, they're actually getting something in the 4s. So borrow in the 6s to receive in the 4s. I can come up with a theory. It wouldn't be their theory. I could say it's all because they're so sure that rates are going to come down and price is going to go up. And so they're willing to run negative carry, even though these funds are income funds. They're willing to give you less carry. And on top of it, you get less because they get more fees. I already said the managed asset part. If they're levered, then they're going to get more fees. But to lever a California muni, you have to borrow short term in the 6s and invest in the 4s. And so this is where the moral hazard part, it's just, you can't even believe. It's like, please, we run $4.5 billion at Saba Capital. Please, at 4.5, this is we try to treat investors fairly, ethically, put them first. At $1 trillion, when is it enough? How many trillion do you need to put investors first? And so what are you afraid of? What are you afraid of when you merge so ECAT is not levered. It would be trivial to merge it. There wouldn't be any leverage change. But so the leverage, to your point, the leverage is often considered an attribute, but it can be used to excess. And it also, the manager uses it at full leverage, almost always, all the time. So when I look at a closed-end fund, some of them don't have leverage, by the way. I look at an unlevered closed-end fund and say that one at minus 14 is much better than a levered one, because it's almost like if anyone knows how to count cards, it's like dividing the raw count by the number of decks to get the true count. Like if I have 50% leverage and it's at minus 15, it's almost like, I have 50% more stuff. So 10 million is 15 million of stuff. I'm going to say that a minus 15 is really a minus 10 because I have to divide that by the leverage. So we do look for low levered funds, but there's nothing per se in general wrong with the leverage. But when we think about BRW. So act as, do as I do, not whatever that expression is. So I'm trying to show through leadership of an actual closed-end fund that we're not going to always be at max leverage. And so BRW has often been risk averse, safe, which really gave us a great result on the NAV in 2022. And so we don't run it always at full leverage. Yeah, you asked about our fight record. Ultimately, we have won almost all of the campaigns. A couple of them we were losing, but here's another interesting fact. We're in a consolidating industry. When a manager buys another manager, now the burden goes to them. For the deal to close, they don't need to get LP consent at 50.01%, which might be hard, versus us to overthrow management if they're doing the wrong thing, needing 50.01. They need 66 2/3. So for Morgan Stanley to consummate the deal with Eaton Vance, and I'm a huge fan of the leadership at Morgan Stanley, and I know them quite well. Eaton Vance needed 66 2/3, but the shareholders were so upset about performance that in a board election, I might be getting this wrong, we actually won 81% of the votes. And on that board was not some random team of Eaton Vance people, and included the actual CEO of the company. So imagine David Solomon or Lloyd Blankfein, that they had the time to sit on a closed-end fund board with all the 100 billion other things they have to do. And if they did, to lose 81-19. So in consolidation, we were able to win because the odds shifted, because they needed 2/3. Otherwise, they'd have to go into liquidation because they would not be the rightful manager of that fund. So consolidation has been very good for the industry. And I also want to just say, like they say about reading, the first few pages of the New York Post or the, 10 o'clock news, like I'm here talking to you about things going wrong. But I have to say, there are a number of managers who, without us ever even talking to them, and maybe it was not even related to them seeing us come up the holders list as, 5% holder, 10% holder, managers that have done smart things, managers that have done things that I don't have an opinion whether they're smart or not smart, but their funds are not at discounts. You could look at PIMCO and find there's only really one fund at a discount in the MLP space. And MLPs, I think, are fascinating. Goldman Sachs, by the way, GER, which I tweeted about a couple of times recently, decided, hey, this thing has been a -20 for 3 years. We've tried our best. We tried various things. Enough is enough. Simply announcing that we're going to liquidate the fund, which is trivial, selling a couple $1 million of individual stocks over some reasonable period of time, will give investors a 25% gain. 80 would go to 100. And guess what? It was announced June 6th, June 7th, June 8th, maybe. It's liquidated already. Okay. They announced it. And I tip my hat to Goldman Sachs because they had, millions of dollars of fees in perpetuity if they wanted to pull the BlackRock maneuver or the Franklin maneuver. And they, without us even speaking to them, I never once spoke to them. They just said, this is the right thing for shareholders. They didn't need me to speak to them because they are an institution that, critique them for things big or small, whatever. I'm not getting into it, but they are a set of, in my view, some of the most impressive people on Wall Street and actually often act as leaders. And then an example where we were really impressed with what the manager did. This will tell you how much inefficiency there is in the market. And why am I talking about this so much? Because there's no Ken Griffin in this market. It is a set of retail investors that don't know what they own, that want to get out, that there are not enough guys like us, although there are a lot more buying at these discounts. I can tell you that the cavalry is coming. We see smart investors showing up on holders list. But another example was there was a closed-end fund with equities in it, one sector that was at a 14 discount, and the same manager, which is Guggenheim, had closed-end funds with the same sector in it. I think it was the utility sector or the energy sector. I think it was utilities at an 11% premium. And so you have not closed end versus open end. You have closed end versus closed end, same manager, same industry. One's at +11, one's at -14. So what did we do? We started buying the -14. At the time, -14 was appealing. Now we get out of bed at -15 or 16 and we buy with both hands, at higher levels. And they came up with the idea of merging the discount fund into the premium fund. So we're going to make it a bigger fund, lower expense ratio, same basic portfolio. And the -14 merged with the +11. Saba may or may not have hedged itself by shorting. One could have hedged themselves, let me say it that way, by shorting the premium fund. You can't get a good borrow, like a borrow in big size on premium funds, but on funds you want to short. But your long collapsed against your short because they became the same thing. And 25% was made the ultimate resting spot for a -14 merging with a +11 a few weeks after, I think, was something like +9. So it's not like it was the GPM. Someone's writing to me, GPM went into GOS, and, it was brilliant. It was brilliant. And I tipped my hat to Guggenheim. So I wanted to spend this minute or two to say, this is a space where, you're seeing me fight, but it's not because I want to fight. It's because I've seen good governance and I've seen bad governance and I've seen terrible governance by the supposed governance king, the one that has raised $100 billion in the back of, we know what ESG is, but we're going to say, here's what ESG is. You shouldn't be on more than 4 public company boards. That's what BlackRock has told the world. US companies, European companies, you should not be on more than 4, but BlackRock board, closed-end fund boards sit on 70 BlackRock boards at the same time. And it's just not reasonable for the reasons that BlackRock said, that you could properly administer 70 boards on top of all the other responsibilities and other boards that one might sit on and your daily lives. And what do you do? By the way, sorry for now going into this new world, but let me say one thing. What do you do if 3 of those funds are terrible performers? Well, are you supposed to think locally to that fund, or can you not help but think globally? Well, if you're the board member of a single fund that did terribly, you may decide to do the right or wrong thing, but your thoughts are pure because you're only on that one fund. If you sit on 69 other boards and you receive paychecks from the same address, you're thinking also. You cannot help but not. It is human nature. What are they going to think of me when I have to renew my contract with them? And there's so many people that would love to step into my shoes. What are they going to think about me on the other 69? And so you were basically on the dole. They're your drug dealer, and you are getting paid $7,000 checks for 70 boards. You're getting $500,000 a year. Don't rock the boat on that one because you have to think about the 69. I'm not saying anyone's doing that. I could not possibly know, but I'm thinking about behavioral, reasonableness. And I agree with BlackRock. You shouldn't be on more than 4. By the way, they're talking about 4 boards across 4 different companies. I mean, 70. So it's not 5, it's 70. So I look at that and I have this, on the one hand, we have our Goldman and Guggenheim examples. On the other hand, we have our Franklin and BlackRock examples. And I find this space so fascinating because we're talking about earning equity plus type returns for taking the risk that the system of voting actually will not be undone, that actually I can vote my shares. Actually, if I can get to 20% stake and I see other investors that are not asleep at the wheel, I just assume we're going to win. And so the longest-winded answer in the history of Twitter space is to say, yes, we've won almost all the time, but sometimes it takes 2 or 3 years and it's painful. And we don't always win, but we've won. And in the case of BRW, I don't want to overstay my welcome. It's a third example of the managers doing something just incredible and incredibly bad. And that led to the ultimate handover of the fund to us.
And that's a perfect place to wrap this Twitter space up. Everybody, please make sure you follow Boaz Weinstein here on Twitter. If you're interested in learning more about Stop, obviously check out their website, and hopefully I will see you all later. Thank you, Boaz. Really do appreciate it.
My pleasure. Thank you, everyone.